in terms of what I was saying earlier, I knew this business, I knew this company, and I kind of been invested in this bank on and off for several years now, ever since the crash in late 2014. So as I said earlier, you should be buying what you know here. You should be doing new work, right? So some of the other things that we knew, I've actually one of the things that I think we did quite. I suppose we pivoted for value investors. We actually got quite bullish on tech stuff some time ago. We kind of got comfortable with we got comfortable with the idea that things which are optically expensive are not necessarily intrinsically expensive, and so we did get some good. We did quite well with some tech names, some growing names. Effectively, we were buying some growth stuff, and I think that some of those names just got absolutely smashed, and they're now kind of trading at not necessarily the headline Facebook, Amazon, Google, but you go down a rung. I said Booking.com. I think that's a very good example of a company with just absolutely bulletproof. Balance sheet, bulletproof as you get, business model, kind of just throws off cash, dominates its market, and is still getting double-digit growth, and it's still going to be around when this corona thing wears off. And again, I look at that and I can see, on a prudent case, I can see double-digit returns on a kind of 5 to 10 year view. I think more likely you're pushing kind of 20% returns. So I think that when you're looking at some of these names, some of the things that, so I said that's not CLO.
Sorry, when you say 20% returns per annum, you're talking about over a period of time.
An expected annualized return of about 20%, right?
Yeah.
So I think first select names that I know, I'm looking at 10 to 20%. I think, and that doesn't mean that in 6 months' time they won't be an expected return of 30 or 40%, right?
Yeah.
But, it makes sense to buy them now. It makes sense to say, actually, that valuation works for me here, and therefore I'm actually okay. Yes, I'm scared about how far this goes. Yes, I'm scared of a credit event. Yes, I'm scared that actually when the shit really hits the fan in the US, there's going to be a mass panic. I get all of that, but there's still enough for me to be doing right here.
But that works PA and it works in a family office, but in an asset management business that doesn't work, right? Because most people can't afford to take pain for a period of time. Pain is, as we know, all of the greatest macro traders in the world can take extraordinary pain because what they're looking at is the risk versus the reward, and they understand that.
Yeah.
But the average investor invests in an asset management firm who's taking bets like that. It's hard to do. How are you thinking of that?
Well, we haven't got our asset management business set up yet, so it's very easy for me to talk about it, before you're actually doing it. But I think, what we're in the process of building is a very diversified fund of funds. So we will be looking at fundamentally diverse asset classes here. Equity will be a very small slug of that, probably less than 10%. My partner in this is Rentec, so he will be doing a lot of the quant, helping with some of the credit, but we'll also be, spending a lot of time on, I think, more kind of niche areas of credit, more niche areas of the loan market. Some of the different, the insurance market is older than the equity market. Phenomenal opportunities in the insurance market, whether it's catastrophe or whether it's longevity, whether it's mortality or morbidity. There's all sorts of very, very unique return streams that you can pick up with varying degrees of liquidity. So in a situation like this, I think the answer is you don't just want to hedge your return profile, so that you've got genuine correlation. And by the way, having a portfolio of developed market equities and emerging market equities, that's not a diversified portfolio, right? That's just an equity portfolio, right? And then if you put 60-40, so you get 40% bonds, and you've still got basically an equity portfolio. So that's not diversification. If you want real diversification, you have to just move completely away from equities. And I said that's kind of one of the things we're doing. But the other thing that you have to have diversification of, it's not just the return stream, it's the liquidity. So you can't have, well, it depends. If you've got, say, a very kind of, suppose you're investing in a bunch of different managers who do lots of kind of different things, but they're doing quite esoteric things. So they need They need time. You can't just redeem on them and say, I need my money at the end of the month, right? They need 12 months to get your liquidity back. And if all the managers are like that, then you've got 12 months. Effectively, your fund will be offering 12-month liquidity because the managers that you're invested in are offering 12-month liquidity. The problem is, in a situation like today, there's absolutely nothing you can do. You can't take advantage of any of these dislocations because you have no liquidity in your portfolio. So what you want to do, you have to do, is diversify your liquidity profile as well. So if you've got some uncorrelated assets, can also be very liquid. Two good examples would be systematic traders, quant traders, trend follows or mean reversion, whatever they're doing, and catastrophe bonds. Right, catastrophe bonds obviously doesn't kind of correlate with the broader equity market, but you can get rid of these things in a couple of weeks' time. So here's two sources of liquidity that, if they're doing their job properly, and actually catastrophe bonds absolutely have quant, doing what they usually do, you would have firepower, you would have liquidity to allocate to some of these dislocations, whether they were in CLOs or some of the kind of NAV discounts in the unit trust market, et cetera, et cetera. So it's not just about diversifying your return stream; it's about diversifying your liquidity profile too.
There was one area I still wanted to talk to you about, because I know a lot of the people on Real Vision have looked at it. We've had various people on, which is uranium. Just love to get your updated thoughts of where we are with that.
Yeah, so we've actually just invested a bit more in that idea. It's something that we came across a few months ago. I'd heard about it. I hadn't properly looked at it. I spoke to the guys at Segra. I spoke to Adam and Arthur, and really spent a lot of time with them. And they kind of talked me through it. Did some reading, and just it's just such a no-brainer. Nuclear is a no-brainer to me. So I thought that nuclear was, well, I still think that nuclear is a no-brainer. So that's the first thing. What does that mean for uranium? I thought uranium was very, very attractive late last year. I think very, very clear deficit in the market. Since then, we've actually seen, we were seeing already a lot of mine shutdowns and mothballing of capacity. We've just seen Cameco shut Cigar Lake. I think we saw another big shutdown as well. I really feel uranium is, I think this would be more kind of event driven. But I would view this more in terms of the optionality. But I kind of look at uranium and see a kind of 5 to 10x, over the next few years here. So I think that I think this is just a great time to be investing in some of these places. Again, do you know how to do this? Do you actually know how to value a mining company? Do you know how to value a mining junior or explorer? Either you do, in which case, great, you go and do it. Or you don't, in which case, find someone who does. Right? Someone somewhere should know what they're doing.
Yeah, true. It's a complicated world. I mean, I was short the HYG just because I wanted an easy way to hedge. And then, it fell out of bed and I made a bunch of money in it. And then I asked myself, the question is, do I even know what's in it? I'm like, well, at this point, I'll have to leave it to somebody like Dylan, who's going to do the homework. That was my macro view, is this is probably going to fall. I'm like, now it's time to give it to somebody who's actually going to do the work to know whether, I'm stupid by doing this or not. And you can take opportunity without being deep by having a view. Like you're saying, your clear view is nuclear is the answer. Therefore, is there an opportunity to take that bet that's cheap? Yeah. Which it probably is.
Yes.
And then after that becomes complicated is how do you structure a trade like that?
Well, I think that's right. But I think, again, I should say, if you don't know how to do that, find someone who does, right? But if you're going to find someone who does, you've also got to know how to spot someone who is legitimate when they say they know what they're doing versus someone who is not legitimate. Because nobody, if you sit in front of a fund manager, right? You're not going to find a fund manager that says, I'm Mr. Average. I don't really know what I'm doing. We don't pay that much attention, frankly. We just kind of, give us your money and we'll put it to work and, fingers crossed. You never hear that. But frankly, that would be the correct answer for a lot of them. So you have to kind of, there's no substitute ultimately for doing your homework. If you're going to get.
And I do think that it feels to me that the future of this industry is a rejection of asset gathering and more about specialist expertise.
Yeah, I kind of hope so, but I'm not so sure. I'm not so sure because I think people have very, very short memories. I really think people just chase returns ultimately. And, it's such a strange industry. Finance is such a strange industry. If you're making mobile phones, then obviously you want customers or prospective customers to look at that mobile phone and to hold it and to feel a connection to it and to enjoy the experience of touching it and really feel a connection, really, really like this mobile phone. Aesthetically, this is a beautiful thing, right? That's what mobile phone manufacturers do. That's what car manufacturers do, furniture manufacturers, pretty much everything. If you're an investor, if you've got a portfolio that really looks great and it's got all the stuff that everyone loves, it's going to be a disaster, right? The only kind of portfolio that's really going to generate decent returns is going to be one that kind of makes you want to puke. And that right? And that doesn't sell, right? That never sells. No one wants to puke when they look at a portfolio. So I just think this is kind of a structural quirk of the industry. That it's just.
I can't wait to see how you're going to market this fund. Well, look, I've got a portfolio. It's going to make you want to feel sick. You're going to call me an idiot, but then you're going to give me some money. That's the pitch, right?
Yeah, you could say, maybe I haven't thought this through.
It's all right. You've got some charm. You'll get through. And if you use your Scottish accent broad enough, they won't understand a word you're saying anyway. So